Hi everybody, I'm Tu Pham, an equity analyst at Viet Securities, a brokerage firm in Vietnam. We provide a wide range of bond and equity-related products and services. So I have been covering listed steel companies in Vietnam for roughly 2 years. And today I would like to focus on Vietnam demand drivers. So I want to say my view that Vietnam steel industry has shown support from the after effects of the pandemic to grow. Besides, the competition from Chinese steel producer is decreasing. Hence, Vietnamese producer can have a better profitability in the medium term. Lastly, the consolidation in the Vietnam steel industry is accelerating, and only strong and large producer get profits. Firstly, Vietnamese producer has a good position to compete and increase sales in export markets because the steel production was not hit by the pandemic. As you can see, as you can see in the first chart, despite the pandemic, Vietnam steel production still grow in HRC and cotton steel segments. Meanwhile, according to the World Steel Association, the production volume in the Europe and North America decreased by 5% and 50% respectively. So the strong demand from these markets has boosted Vietnam's cotton steel export. As you can see in the second chart, Vietnam cotton steel export grew by roughly 14% in 2020. I think there are two key reasons why. Firstly, the supply recovery was low in the Europe and the North America. Meanwhile, the recovery in the demand is recovered in the highways. Secondly, the EU quotas on steel import from Turkey and China has made room for Vietnamese producer since throughout 2020. So I think that Vietnam had well managed the pandemic, and this creates the good position for Vietnamese producer to seize opportunities from the recovery in the demand in our sea. So due to the inadequate supply demand recovery in other countries, export volume growth will boost the cost producer profit. Several domestic manufacturers such as Nam Kim Group and Hoa Sen Group have received sufficient orders mainly from the EU to run their factories at full capacity until August 2021. Coupled with the increase in flat steel price, so within they will have a very high profitability in the first half of 2021. Meanwhile, the threat to export in the next year is new anti-dumping taxes in Malaysia and Indonesia, but we think that it will not affect cotton steel export in the short term. Besides the high demand from overseas, we think that the domestic producers will not face the great challenge from Chinese producer as in the 2017 to 2019 period. We noticed that Vietnam steel import from China in 2019 and 2020 decreased by 18% and 32% year-over-year, respectively. It's a bright side for Vietnam domestic market. domestic producers, such as Hoffac, Vietnam KOA, or Tisco. On the contrary, Vietnam even export steel billets to China market. And you can see in the chart, Vietnam's steel export volume to China has grown by more than 700% year over year in 2020. I think there are two reasons. The first one was China experienced a shortage in supply in after the pandemic. Besides, the competitiveness of Chinese producer has weakening. It can be seen by the steel price in China and in Vietnam. In 2020, the production costs in Vietnam were even much lower than in China. So many China producer has import steel from Vietnam to meet the demand in Chinese market. So I think there are two reasons why Chinese steel industry competition is declining. The first one is regarding the production cost. We think that higher required scrap use and low emission controls will boost the production cost in China. We calculate that the production cost to the cost to produce a ton of liquid steel in Vietnam were roughly 20% lower if we use basic oxygen furnace instead of electric arc furnace. Because steel scrap makes production cost higher, the steel production cost it become expensive in China. Given that the basic oxygen furnaces are required to use more scrap. Secondly, China being on coal import from Australia, the largest coal supplier in the world. We also affect negatively to Chinese competitiveness. So we think this will create opportunity for Vietnamese firm in the foreign market, in the cotton steel or construction steel segments. Meanwhile, in the domestic market, Vietnamese producer will not face the harsh competition from Chinese producer, as it was in 2017 to 2019 period. So in the short term, we think that Vietnamese producer can maximize their profit by size the export opportunity, but in the long term, the domestic demand will be the main market, and we think that there are bright side in the domestic demand. In our view, the construction demand will be supported by the public investment and FDI inflows. Firstly, regarding the public investment, Vietnam aims to spend a large investment in infrastructure projects, especially bridges in the south. In Vietnam, we think there are the inadequate investment in three main reasons. The southern area was relatively underdeveloped compared to the northern Vietnam. There are many large bridges projects in progress. For instance, the construction of Mỹ Thuận Harbor Bridge has been began in the fourth quarter of 2020 and cost of roughly $200 million and will be completed by 2023. Meanwhile, another key expressway cost roughly $200 million and also finished by 2023. About FDI inflows, as you can see in the chart, registered capital and dispersed capital was decrease in 2020, but within that, FDI inflow can surge and boosting the demand for cost steel buy and also coal processing service. Within the drop in spare capital was partly because the lack of vaccine for COVID, and now the vaccine is available. So within the investment progress can be boosted faster in the 2021, and Vietnam has strong competitiveness to attract FDI. Firstly, Vietnam has the good ability to control COVID-19. The country also have FTA with many large economies such as the EU, Australia, Korea, and Japan. Besides, Vietnam has a large consumption market and also a low labor market with the Vietnam also have the large labor market with low cost. The Economist Intelligence Unit has rated Vietnam higher than India and Indonesia in almost all categories. Within these two countries are the main competitor to Vietnam to attract FDI inflows. Another point to in another proof that Vietnam is the attractive country to uh, international manufacturer is that the country also the one of the Japanese company favorite countries to expand their business. Roughly 50% of Japanese companies that leave China has choose Vietnam to open the new factories. So briefly, within that, domestic producer would benefit from selling cotton steel and steel wire to build new factories and provide car service to manufacturers such as Samsung or LG, who produce automobiles, washing machine, and refrigerators. Lastly, lastly, I will mention to the oversupply in Vietnamese steel industry. We noted that the new capacity can lead to the harsh competition and put pressure on small and medium producers. In construction steel segment, the last additional capacity from Dung plant and Bomina BOF mill is equivalent to roughly 90% of the South consumption in 2020. This led to the lower price of steel in the southern compared to the northern Vietnam. So I think that small EAF mills will face great challenges to survive in the following years. Meanwhile, in the flat steel segment, running SRC production lines commercially in full capacity in the fourth quarter of 2021 will help SBC Hafak Group to increase their competitiveness in the flat steel segment. So this could lead to the oversupply in the cotton steel and steel by. And we think that Hafak Group has a very strong competitiveness, and they can expand their cotton steel and steel by factories in the following years. Currently, the whole cotton steel supply can produce roughly 7.1 million tons of steel per year. Meanwhile, the consumption was just roughly 4 million tons in 2020. So the utilization rates in cotton steel factory are just was just 45%. I think this rate is relatively low, and the oversupply is pretty serious now. Meanwhile, in the steel bar segment, producer running at a utilization of just 7.75%. After completing the HRC production last, Perfect Group will be equipped to boost cotton steel production volume in open new steel bar factory in the south. In recent years, we noticed that the competition in the industry had derived from the large producers getting busier. As you can see in the chart, SBG, aka Harvard Group, actually 23% 5-year CARG, and it's always ranged from 16 to 33% recently. In contrast, small-scale steel mill and those operate downstream such as rolling, galvanizing, has been increasing struggling to retain profits. For example, POM, CDX, TMB. The surge in the ROE ratio of S, um, HSG and NKG within that is just the high level in the short term due to the surge in the steel price. In the long term, within that, the steel market consolidation will only benefit the largest producers. We have relatively complete production chains. So to summarize, let's quickly look at the main points regarding the main drivers. Uh, Steel exporter can trade opportunities from the Europe and North American markets, mainly in the cotton steel segment. Meanwhile, in the domestic markets, we think that they are right side. Only investment in infrastructure projects and FDI inflows will still support the steel demand in the next 3 to 5 years. Um, and the new capacity could lead to a harsh competition and only a few business and last and strongest producer can benefit from the developing trend in Vietnam. Thank you all for listening. It was a pleasure being here today. Feel free to have a question on Vietnam steel industry, and I have some time to answer your questions.